Well, good morning to the family, and thank you for joining us for some Primerica training. We're going to be doing this a lot more regularly, and I want to make sure that everybody understands what our products are, what the enemy's products are, and how we can overcome the enemy. So we're going to be talking about that a bit today. For those who are new. Especially, but as a reminder to those of us who are old, Primerica is a business. We get into Primerica because we either want to help people through business, we want to learn some things, and hopefully this class will facilitate that. And we want to be able to make some money. A person can start off making money even before they're licensed, if they're willing to get a license so that they can be paid the money. But we want to make sure that people don't get involved with high hopes of making money, and then we drag them along as other companies do. No names, but some of you know exactly what companies I'm talking about. And they drag people along and they say, oh, this is part of your training. Well, you're going to be great one of these days. And then they don't help them to get licensed. They don't help them to know how to do anything for themselves. They just are watching some high-powered leader do all of the business for them, and by the way, collect all of the money. We don't want to do that. We want to make sure that you get trained and you get ready as soon as is possible. So we make available to you bonuses at the very beginning so that you can see these presentations. Now, while I'm doing this, we're in the midst of a national and international crisis where we're not really getting together with other people and all of that, but we can do it through Zoom, for example. We can do these training classes through YouTube, and so it's very possible to continue without having any gaps in your training. And that's what I want to make possible for you through this class. So even though Primerica is a business, it started off as a crusade. And I know the word crusade can be seen to be kind of a lame term, kind of rhetoric. But let me tell you what I mean. When I first heard about this company, I had made every possible mistake. I had 2 life insurance policies that were the wrong kind. I had my money in Great Western Savings and Loan. That lets you know how smart I was. They're not even around anymore. I had debt up to my chin, and every possible mistake it was that I could make, I was making. And I had the way that I ended up with the life insurance policies, for example, was a fellow came from another company. Now, I don't want to say the name of the company, but their initials are, well, anyway. But they came and they said, now, Dave, how much money have you saved so far? Well, I had been a college professor. So how much money do you think I had saved so far? None. Every college professor I ever knew had a part-time job. I didn't have a part-time job, so I hadn't saved any money at all. And they said, well, how would you like a forced savings? You know, you can put money into this policy, and it'll force you to save money, and you'll have money to leave for your wife and children if anything happens to you. And I said, well, I don't have any wife and children. They said, well, that doesn't really matter because you still have the forced savings. Who would you leave the money to? And I ended up buying the policies because I wanted to be a responsible adult. And then I ended up having these policies for, about 3 years. And the savings wasn't building up very fast. In fact, I still was not up to the point where it had come up to the money that I had put into it. And so I didn't pay any attention to it. I said, well, it's cheap, and I'll just continue to put money into the premiums. And a fellow from this company by the name of Chris came and talked to me. And he said, Dave, I understand you could use a part-time income. Now, let me tell you, this is a little aside, and I'll tell you the rest of the story and bore you to tears. But let me tell you, it's much, much better to approach people from the point of view of a part-time income rather than to try to approach them from the point of view of, hey, how would you like to save some money on this and that and the other thing? Nobody wants to save any money. Nobody wants to buy anything. Nobody wants to sell anything, but everybody could use some part-time income. And so he knew that I was a teacher, and I jumped at the chance. I said, yeah, I'd love some part-time income. And he said, okay, well, let's see how you're doing with your financial life. He said, well, what do you have in savings? I had some money in the bank. The bank in those days was paying pretty reasonable interest rates, but it wasn't even close to inflation. Inflation was extremely high in the 1980s, so I still wasn't keeping up. And so he said, well, we can fix that. And then he said, do you have any credit card debt? I said, oh, yeah, I got plenty of that. Okay, well, we can help with that too. He said, do you have any life insurance policies? I said, yeah, I do. I have 2 life insurance policies. He said, really? I thought you were single. I said, yeah, I'm single. He said, well, who are you leaving the money to? I said, oh, my mom. You know, she's been trying to buy a house and all of that. And he says, well, is your mom kind of hard up for money? And I said, no, she's fine. He said, then why is she the beneficiary on your life insurance? But why do you have life insurance at all? And I said, well, Chris, do you sell life insurance? He said, yeah. I said, well, I don't understand. Shouldn't you be trying to sell me life insurance? He said, no. I said, why not? He said, because you don't need life insurance. And all of a sudden, I started thinking, now, either he is the stupidest salesperson I ever met, or maybe he knows something I don't know. And maybe he's the most honest one that I've never met. Turned out to be the latter. He introduced me to a fellow by the name of Doug Hartman. Doug Hartman said, well, now, Dave, I understand you have a PhD in mathematics. You've worked at Northrop on the stealth bomber. You've been a professor. You've taught at USC. He said, you know, those are all liabilities you can overcome and still be successful here, because all you have to do here is you got to be able to read and point. He said, and then if you get really, really good at it and you want to get fancy, point with the other hand. John and Mary, do you want $100,000 for $100 a month, or do you want $250,000 for $80 a month? And I started to think, well, you know, that sounds pretty simple. Primerica is a simple business, but it's not an easy business. Now, I'm not contradicting myself there. Primerica is not easy. You're going to earn every dime you ever make in Primerica, but the problem is that people are the variable. When you're dealing with human beings, they don't always make the most logical decisions. And that leads us back to the crusade. When our company founder, Arthur Lynch Williams Jr., got started, he got started because he was absolutely furious at the life insurance industry. And I learned that fury myself from my 2 insurance policies. Chris, the fellow I told you about from this company, analyzed my policies and found out 4 things about them. Number 1, for the first 2 years, I didn't earn anything. As a matter of fact, for the first 2 years, they drained the money out of my so-called savings account, my cash values. They kept it. I lost it. 2 years later, the balance in my account was 0. Well, I never would have accepted that from the bank, but somehow I had accepted it from these insurance policies. Feature number 2, the interest rate that I was earning on the average, nationwide, the average is 1.3%. That wasn't my average. Mine, if I kept it for 20 years, mine was going to be negative 1.5%, meaning that I would have put more money in than the actual balance in my cash value account. That's a disaster. But the third thing was, suppose that I wanted to take some money out. Suppose that I had an emergency. He said, oh, you can borrow that money at any time. And I thought, wait a minute. Chris asked me, why do you want to borrow your own savings account? Why do you want to borrow your own money? I said, well, now there's a novel question. Why do I want to borrow my own money? And then finally, he said, well, none of this really matters. I said, why not? He said, because everybody dies, and the day you die, all the cash values go away. They keep it, and your family loses it all. I said, what? Show me that. Show me that in writing. And he showed me in my policy all 4 features that I just described. And I understood the fury that Art Williams had back in the 1970s when he first started thinking about this concept. And a relative of his told him, I think they were at a party if I remember right, but he told him, Art, when your dad died, your mom didn't have to get $15,000 from a life insurance policy. She could have gotten $100,000 from the right kind of insurance. And I said, what do you mean the right kind of insurance? And this fella explained to him, well, she could have had term insurance and she would have paid for the same amount of money. She would have gotten several times the amount of coverage. Art decided to study and find out if his cousin was telling him the truth. And sure enough, he found out he was. Art Williams amassed the world's largest collection of information on life insurance. He had a huge library of books because he wanted to know the truth. He found out the truth, and he began his own company on February the 10th, 1977, and you are a part of that company now. It was built on a crusade. It was built on the fact that he was angry with people who would cheat his mother out of being able to get enough money when her husband died. And that's what they've done for hundreds of years. Now, just a little bit of history of the life insurance industry. Life insurance actually began before the time of Christ with what were called burial clubs. And they would have arrangements among them where they would take care of the burial of someone who passed away. But more formally, life insurance in the 16th century, specifically in 1563, I believe it is, or is it? No, I'm sorry, 1536. I'm getting dyslexic with figures, and to think I'm a mathematician, it's really sad. In 1536, in the month of June, actually, a man applied for a life insurance policy. The name of the insured was Mr. Gibbons. And Mr. Gibbons had this policy. In those days, everything was term insurance. But this was the first term insurance policy. This was the first one. It was in England. And he applied for a 1-year term policy. So if he died within the year, then the insurance company would pay his beneficiary. And William Gibbons died 11 months. In fact, he died just before the year was up. And the insurance company refused to pay. And they said, well, because it wasn't a 1-year policy, it was a 12-month policy, and a month has 4 weeks in it, and he was 48 weeks and 2 days into the policy when he died, and so the beneficiary doesn't get the money. From the very beginning, life insurance companies started trying to cheat people. But when you take your insurance exam, or most of you are already insurance licensed, when you took your insurance exam, you found out that a life insurance contract is what's called a contract of the adhesion. If you think of adhesion, you think of something sticking together. And a contract of the adhesion is that if the insurance company writes the contract, then, pardon the pun, you're stuck with it. And so you're stuck with the way they wrote it. So if there is any ambiguity, if a lawsuit arises and there's some kind of an ambiguous legalism inside, then the courts will decide in favor of the insured. That's exactly what happened. The beneficiary found out that life insurance was a contract of the adhesion. The courts found out, the courts decided, no, a year is not 48 weeks. A year is 52 weeks, and he died within the period, and they paid the claim. That's how it got started. Not on a very good note. Fast forward about 300 years, people had been buying and selling term insurance for quite a while now, and it was a good idea because if somebody dies and they do have a family and they do have somebody who would have a financial loss in case they pass away, then being able to remunerate that loss is a good idea. And what the way that the insurance companies made out was that you pay your premium and pay your premiums, and a lot of people don't die within the term. So it's fair because people are paying the premiums, the insurance company's making money. Every now and again, one of the people dies within the term, and so all these amassed premiums and whatever the company's earned from it, that's enough to pay the claims. And those decisions on how much premium you have to charge in order to be able to make those payments depends on what percentage of people die. And that kind of information is studied by mathematicians who are called actuaries. And all of the insurance companies have them. So everything was going along quite well. The insurance companies were making money. The death claims were being paid out. And things were fine until people started, insurance companies started saying, this idea of death insurance, which is what it was called originally, is kind of a negative thing. People don't want to talk about dying. People want some kind of a benefit while they're alive. And so what they did is they developed this life benefit inside a life insurance policy, or a death insurance policy at that time. And the life benefit was it's going to build up this little cash value account. So people are now paying their premiums because they have hope. They're going to have a savings, they think. Some of the insurance agents actually called it a savings, but it wasn't legal to call it a savings because it wasn't a savings. All it was what I found out was in my policy. It was collateral for a loan. People had to borrow it to get it out. And so, but people said, well, now I have some hope. I'm going to build up this little savings account. And so they started buying what was called cash value life insurance. Now, cash value life insurance works like this. Let's say that you have a $200,000 policy for which you are paying $200 a month. So here's the face amount of the policy. If you die, the insurance company gives your beneficiaries $200,000. And you're going to do that starting, say, at the age of 35. Okay? Now, in the first, some of the things that they don't tell you, because they didn't tell me, is that for the first 2 years, this curve is flat. This part is the cash value account, the part that builds up that people think is their savings account, and this part is the insurance. Notice how the insurance amount is decreasing as the cash value account is increasing. Now, the decreasing insurance is called decreasing term. You keep paying the same premium, but as time goes along, of course, you're a little older, you're a little more likely to die, so you don't get as much insurance, but don't worry, you're building up the cash value. So, the first 2 years, it doesn't build up anything. The amount in your cash value account is zero. Now, some policies are so bad, and I've been here for 35 years, so I've seen some that are so bad that for the first 18 years, the cash values remained at zero. Eventually, you start building up cash values at a very slow rate, by the way. National average, as I mentioned before, if you keep the policy for 20 years, the national average was 1.3%. But that's better than the banks are paying right now. So, but the first several years, negative 100% rate of return, because not only does it not grow, they take your money out, they keep it, and your balance is zero. Okay? But now you start building that account up, the cash values, decreasing the term so that, let's suppose that you get out here maybe at the age of, let's say you're 60. Okay? And let's give this thing the benefit of the doubt. Let's say at the age of 60, it's built up $30,000 in cash values. You're starting to feel pretty good. 30,000 bucks, not too shabby. Now, the problem is that if you die at the age of 60, then you find out that the way the insurance policy was written is that the total amount that your beneficiary gets is still the $200,000. So you thought you had a $200,000 life insurance policy plus a $30,000 so-called savings account, but you didn't have a $230,000 total. The total was still $200,000 because your insurance had dropped to $170,000. Then you add the $30,000 from the cash value account, and the beneficiary still gets only $200,000. Now, I don't care how a person spins that, because insurance companies and agents have learned how to spin it very well. But however they do that, the client thinks he's got an insurance policy and a savings account. That's not the case. We're going to be talking about another variation of life insurance where they say, oh yes, well now you do get the savings when you die. Don't count on it. We'll show you what's wrong with that. But so this kind of a policy, which by the way is called a whole life policy. Now, suppose you get out here to the age of 60 and you say, man, I really need that 30 grand. I've got some medical bills. We've had some problems. I need that $30,000. I say, hey, insurance company, we'd like to make a withdrawal of the $30,000. Well, you don't make a withdrawal from your life insurance policy. You borrow it. You have to borrow it. And let's suppose usually 6% is a pretty modest interest rate for borrowing your own money. But you borrow the $30,000 at 6% interest. Now, that's $1,800 per year that you have to pay out. That's $150 per month that you're paying in interest on the $30,000. Okay? Now, here's the difficulty. When you borrow that money, it's bad enough that you're paying $150 a month, and of course you're still paying the $200 a month. But when you borrow that money, then if you should die, the money that you borrowed and the interest gets subtracted from the $30,000, gets subtracted from the $200,000 death benefit. Now, what does that mean? That means if you die, then your beneficiaries get $170,000 minus whatever interest is due. And the interest is generally charged in advance. So, if you thought it was a bad idea to pay $200 a month for $200,000 in coverage, how do you feel about paying $350 a month for $170,000 in coverage? That's how this thing works. And so all four of the features that Chris had shown me about my insurance policies, well, all four of those features were in the standard plain vanilla whole life insurance policy. And the insurance companies got absolutely stone wealthy. In the the first half of the 1900s, they were going door to door. They were selling these little policies to people who didn't understand it. And they say, okay, la firma aquí, por favor, and people were signing the policies all over the country. And some people were buying larger policies, like myself, by the way. And then Art Williams started this company, the company you're in. And we started telling this story everywhere. The insurance companies went berserk. They actually had blackballed the woman who taught us that concept of those 4 features in a whole life policy. She did that in chapter 13 of a book that was called Money Dynamics for the 80s, which was a great book. We all went out and got that. The company was actually publishing that chapter until the insurance companies went bananas about that. The chapter had to be removed from the book. And of course, Vanita Van Caspel, who was the author, just got blackballed from everything. But the insurance companies didn't play fair. The insurance companies didn't compete. The insurance companies lied. And they tried to put Art Williams out of business. And in fact, the commissioner in the state of Georgia stood up on his desk and told Art Williams, "I'm going to put you termites out of business in 30 days." A lot of insurance companies called us termites because we believe in term insurance. Term insurance is less expensive. So I want to talk about that for a minute because this is important for you to get. Now, there are 3 kinds of term insurance. One of them is called annual renewable term, ART. And this really starts off the least expensive because here's how it works. The older you get, the more likely you are to die. So every year the premium goes up a little bit. So the coverage stays level. Level coverage, but increasing premiums as you get older. Okay, well, that's fair. The second kind is called decreasing term. That's the kind that's inside this whole life policy, decreasing term, because you pay the same premium, but of course, the older you get, the more likely you are to die, so the less insurance your premium buys, so it's decreasing coverage. And then there is a third kind that is called modified or level term, where the coverage and the premium stay level for a period of time. Well, what period of time? That depends on the policy. The longer the period of time, the more expensive the policy. And that's fair because the insurance company is taking more risk. So the first kind, annual renewable term, is really good for like business insurance. You know, if a couple of business partners go into business together and one of them were to die, maybe one of them has an expertise in handling the books, the other one has an expertise in running the equipment, and if either one of them were to die, then the other one is going to be lost trying to go out and find somebody else to do the job that's missing. And so they get a life insurance policy on each other, and the cheapest one to get is annual renewable term, and they figure, okay, if anything happens in the first few years, then it covers us. It was inexpensive, and if we both live enough years to where it starts to get too expensive, well, we'll just forget about it then, or we'll get another annual renewable policy because now we're starting to understand each other's functions, and maybe the guy that runs the books, would not be as hard to replace by the guy that runs the equipment. So that's the idea, and ART is perfect for business insurance. Decreasing term, on the other hand, is good for, say, mortgage insurance, because as you pay on a mortgage, then eventually, it takes a long time, but eventually the balance that you owe on your mortgage starts to decrease. It's called amortization. And as that decreases, your family is less liable for the mortgage. You might have had a $400,000 mortgage at the beginning, but after years, you're paying on the thing, and that's decreased maybe to 380, 370, 340. And as that decreases, you need less and less insurance to cover it. So decreasing term is good for debts. The third kind, level term, is good for families. It's good for families because they can budget for a period of time. The family gets a level term for 35 years, say, and then for after the 35 years, well, they've built up a savings account. They've built up a retirement program. Primerica's come in, showed them how to set up a Roth IRA, and they already have a 7-figure account. And so if they have $1 million+ in a Roth IRA, do they need a $500,000 life insurance policy? And hopefully everybody is saying, no, they don't need it. Money is money. If they've got $1 million over here, they don't need a $500,000 over there. Okay, so our company started with the concept of buy the less expensive insurance, level long enough so that the family can budget for as long as they need insurance, and then the difference between that and the whole life policy, they might be able to get the same $200,000 policy. They might be able to get that for $50. If they get that for $50, then there's an extra $150 left over per month that that they don't have to pay. So they could take the $150, they could put it into a Roth IRA, and that gets them started on that seven-figure account, and they can put more money into it, more money into it. Right now you can put hundreds of dollars a month into a Roth IRA, and that thing turns into a large account. Buy term and invest the difference is the concept that this company was built on. But we spread that message throughout the United States, and it started to catch on. The company started in 1977, as I mentioned to you. By the year that I got involved, 1984, our company was the #1 seller of life insurance in face amount. We sold more than the Prudential. We sold more than New York Life. Prudential was actually #2, and we were just getting started. The following year, we sold more than Prudential plus New York Life combined, former #1 and 2. The following year, we sold more than the first 3 companies combined. And we were just getting going. Now, of course, our company has diversified widely. We are primarily a company that's devoted to investments, to securities, because we want people to be able to retire with dignity. But what are the things that keep people from retiring with dignity? They don't have enough money coming in, so we offer them a part-time income. They have too much money going out with life insurance, so we offer them term insurance. They don't have any retirement savings yet, so we offer them a Roth IRA with retirement savings so that when they take the money out of retirement, it's income tax free. not just tax deferred, but income tax free. Well, how would you like to be able to pull out $1 million tax free when you retire? Or take it out a little bit at a time so you can live on it? That's the idea. And so our primary objective is for people to retire with dignity, to be able to retire successfully. But most people haven't put away any money for retirement. Why? Well, too much money going out. Credit card debt. Now I'm going to get back on the subject of insurance for a minute because that's primarily what I'm teaching you today. Next time the story's going to get even better. But when people have a lot of credit card debt, then we have a computer program called the Financial Needs Analysis. No matter who you are listening to this broadcast now, you need to have a financial plan. You need to have some kind of a GPS that shows you where you are today financially, where you need to be by the time you retire, and step by step exactly how you get there. And we have that. And we don't charge $800 for it or $1,200 like many companies do. We charge $0 for it because we don't believe that we deserve people's business unless we have earned it, unless we've given them something of value. And that financial needs analysis, trust me on this one, that has tremendous value. Just on that one part of the program that gets people out of debt with what Dave Ramsey calls debt snowballing. We call it debt stacking. It's the same thing. It shows you exactly what credit card to pay off first, and then take that money, put it on the second credit card, take that money and put it on your car payment, take that extra money once it's paid off and put it on your home. Worst case we ever had was a couple that we went and saw, and they had I don't remember how much debt they had. It was a tremendous amount of credit card, car payment, house payment, everything. But we went in there and the financial needs analysis computed how long it was going to be before they were out of debt. Well, they were going to be out of debt in 256 years. I said, well, Phil, everybody's going to be out of debt in 256 years. You think you might want to speed that up a little bit? He said, yeah, we'd like to be out of debt while we're still alive. I said, okay, let's run the financial needs analysis debt stacking program for you. We ran that. And it showed them same money out of their pocket, no new money out of their pocket, that instead of being out of debt in 256 years, they would be out of debt in 11 years, including their home. Now, how do you think they felt about us? They just loved us. And of course, they became our clients, and the story goes on from there. But this is where all of this can go. You can change people's lives, starting with your own. So you need to run that financial needs analysis on yourself. End of commercial. Back to the study of insurance. So we started spreading the message of buy term and invest the difference across the country, and the insurance companies went nuts. But they decided, well, okay, if people want to buy term and invest the difference, then we'll let them buy term and invest the difference. And we'll do it with a brand new kind of insurance policy. Now, this is the late 1970s, and it was called Universal Life Insurance. Now, I'm not going to spend a great deal of time on this because we're going to study it in depth next time, but Universal Life Insurance, and by the way, the legal name for this is Flexible Premium Adjustable Life. Things are flexible, things are adjustable. You may not even know how much insurance that you have or how much you're paying. And we're going to study it. We're going to study it completely in the future, but it still has those same problems. See, the life insurance industry in the late 70s could have become big heroes. They could have said, okay, well, we'll combine term and invest the difference. We'll put it into one policy, and the people will get both of them. They'll get the insurance and the savings, and they're paying one premium, so they don't have to worry about how they're investing and all. And they could have done that, and they would have been American heroes. But what happened was They kept the same concept that they had before. You have to borrow your own money to get it out. You don't earn anything for the first few years. And uh, so that cash value increases slowly. Now, instead of getting to the point where the cash values were $200,000 at age 100, they improved that. They lowered it to age 95, but still the same concept. And we're going to talk next time about the two different kinds of options of universal life insurance that are out there, because the reason for these classes is to not just teach you, to not just give you a big brain full of knowledge, but it's so that you can be successful in this business, so that you understand it. We don't want our people out there like many other agents, securities agents and life insurance agents. Many of the people are out there, they're licensed, but they don't understand what they're doing. And that's a problem. Now, if you have a person who sells whole life insurance or other types of cash value insurance that we're going to be studying in the future, you have somebody who's out there selling it, there are two possibilities. Maybe they don't understand what they're doing. They don't know that the client loses all the money in the first few years. They don't know that the client's borrowing their own money and paying interest to take it out. They don't know that the client loses everything in the savings part when they die. There's one option of this type where the agent says they don't lose it. They actually do, and I'm going to show that to you next time. But they just don't know. They haven't read their own contracts. Well, there's another type of life insurance agent, somebody who does know, somebody who says, yeah, client loses all the money in the first 2 years, the savings account part, and I make a lot of commissions for it because the company makes a lot more profits from it. And yeah, I know they have to borrow their own money to take it out, but yeah, boo-hoo. Some win, some lose. That's the way it goes. See, some people know what they're doing, and they still do it. Well, those people are just not very nice people. Now, do you want to buy your life insurance from somebody who doesn't know what he's doing or she's doing, or do you want to buy it from somebody who's not very nice people? And my answer to that is I wouldn't want to buy it from either one of those. I want to buy it from somebody who's a good person, does the right thing 100% of the time, and is fully trained, understands exactly what they're doing. And that's why these classes. We want you to understand exactly what you're going to be doing. Now, we're going to go back next class. We're going to talk a little bit about the other types of insurance. But for now, I want to talk a little bit about why you are in business. Why are you here? You know, when we started off, I got involved, I told you, in 1984. We had a little simple presentation where a company, and the very first page asked a question. And the insurance agent, the Primerica agent at that time, would ask the client this question: why am I here? And then, you turn the page, and the answer is to help you realign your assets, increase your net worth, help you get more value for the money you're currently spending. Those of you who have been here for 35, 36 years are laughing because you remember that presentation and those exact words. But that was the beginning of it. Why am I here? And Jimmy Meyer, one of our great senior national sales directors back in Pennsylvania, Jimmy Meyer was just starting to practice his presentation at that time. And like many of us did, he was sitting there in the bathroom and he was practicing his presentation, with the door closed. And he got to the part of his presentation where he said, why am I here? And his mother heard him through the door and she said, Jimmy, you better know why you're in there. What are you doing in there? Well, we've all had our little embarrassing moments from Primerica. I'll tell you more stories in the future. But that's really how we got started, a simple little presentation. And it's now much fancier. It's in PowerPoint. We've got it on Zoom and all of that. But the principles are still the same. there's a right and there's a wrong, and we're doing what's right. And we're coming against the people who are doing what is wrong in all of the industries, the banking industry and the insurance industry and all of that. We're helping, we're not going after the wealthy. We're going after the people in the middle who are struggling, trying to pay their bills, trying to get their kids through school, trying to make their house payment or their rent payment, and they don't have enough money. So we're there to help them and give them free financial needs analysis in order to help them with their future planning. But for the agent, for you, this is a business. We need to treat it like a business. Now, people who are watching this broadcast are at several different areas of their Primerica career. Some are brand new, and I want to address the brand new person first. The brand new person, what does this person do? Become a nag. Become a nag. Nag your trainer, because you can earn money, you can earn bonuses just by observing field training observations, those FTOs, field training observations. This is where your trainer is doing a presentation for someone that you introduce them to, and as they do that presentation, you're learning, you're getting better at it, and you're starting to understand it, and you don't have to do anything except observe it. You can observe it on Zoom right now while we're going through this critical time in our country, but you can observe those presentations and people take a look at it. They get their financial needs analysis, which they can get through email, and so now they've got all the information. They make the right decision. Yep, I want to buy term. I want to invest the difference. And they do that. And so you're going to get paid a bonus from the company, an extra $200 bonus every time you add one new associate to your organization. And your trainer should be doing that for you. And every time that you observe $1,000 in bonusable premium being done. That's a client buying about an $84 policy, okay, $84 a month. And so that's the first thing that you should do. Nag your trainer to make sure that you're seeing those FTOs, those field training observations. Number two, use your Primerica Online, www.primericaonline.com. We call it POL, and you use that to do your 32 hours of state-required study. You have to attend 32 hours of courses before you can get your first license, your life and annuity license. And so you go through that 32 hours of state courses. You can do it at your own pace, but that's dangerous. Treat it like a business. Do it as quickly as you possibly can so you get licensed as soon as you possibly can, so you make money as soon as you possibly can. Does that make sense? I hope so. All right. So, and you can do that 32 hours of study online. Okay, you can do it online. Check your POL, check your Primerica Online. If you've already turned in your IBA, you're already one of us, you have a solution number, use that solution number, get on POL, surf through there, learn everything that you can, but primarily find out how you do those 32 hours of state-regulated courses, okay? Number three, pass your life exam. Take the exam and pass the silly thing. Because shortly after you pass your exam, you'll be issued a state license. Now, by the time you get your license, your trainer should have helped you get to the district leader contract. That's you get double the commission contract once you become a district leader. Now, what's the importance of that? Well, you make twice as much money every time you do a transaction. So let's give you an example. You're a brand new district leader, and by the way that you get to district leader is that Doug Hartman developed and I updated for our organization what's called the module. It's a training module. It shows you exactly what to do to get to district leader. So it's kind of a covenant between you and your trainer to help you get to that position. It's not contractual. You don't have to do it. Most people probably won't do it, but those who really want to make money, those who really want to be in business, you'll do it. Just like I did many, many years ago, you'll do it. And here's the potential result. Let's say as a district leader now, brand new district leader, you've been in the business now for maybe a couple of months, and you're starting to train individuals, okay? So maybe by that time we'll actually be able to go back into people's homes. But you're training individuals just like you got trained. You're showing people buy term and invest the difference. You're going through the presentation. I'm going to get a drink. Now, fear not, it's iced tea. So now you're going through the presentation. You're doing a financial needs analysis for people that your trainee has introduced you to, and they say, "Well, yeah, I want to buy term and invest the difference," and you set up that term insurance policy. Average term insurance policy, as I mentioned before, about $84 a month. Here in California, it is significantly higher, so you would earn a lot more than what I'm about to tell you. But your earnings on that, if you take 84, you multiply it by 12, that comes out $1,008. And then they subtract the annualized policy fee, so it ends up being 900. Oh golly, I have that figure on the back. $922.50. See, it's nice to have that information in front of you. $922.50, and you get paid, and you're on a 50% contract, you make half of that, $461. Now, how much work did you do? You did maybe an hour presentation, and then maybe another hour showing them the results of the financial needs analysis and asking them the health questions for the insurance application and all. So maybe a couple of hours presenting to the family. Maybe you're really, really careful and you spent 2 hours of preparation for it. So you put in a total of 4 hours. You made $461. So now let me ask you a question. Where can you go to get a part-time job earning $100 an hour? Where? Well, you've already gone there. It's here. That's what it's like, okay? That's what you do if you're a brand new person, 1, 2, and 3. But now you've been around for a while. You're a bona fide, part-time, qualified trainer, taking people out. Part-time, you should be able to do 4 first appointments, because everything that we do is on a 2-appointment system. You never sell anything on a first appointment in my organization, okay? You always, because what did I say before? We don't deserve their business unless we earn it, unless we give them value for it. And the financial needs analysis is the value. It takes you some time to prepare it, then you got to come back and present it to them, okay? So it's a 2-appointment system, but you'll be doing 4 first appointments per week. Now, that's not exactly setting the forest on fire, doing 4 first appointments a week. I was doing much more than that while I was still part-time. I was doing, 10 to 12. One week I had 13 appointments scheduled. Many of those will cancel. So you want to set lots of appointments because not everybody keeps their word. And not everybody, of course, can keep an appointment because there are often extenuating circumstances. But if you have 4 first appointments in a week, you'll probably get 2 to 3 second appointments, and most of those will be transactions. 2 of those will be a transaction. One of those, the people that you talk to will probably get involved. And here's I'm going to reiterate something I said a little while ago, namely, your purpose is not sell, make money. Okay. Yes, it's a business. Yes, you want to make money. Yes, sales are going to take place, but your approach needs to be through opportunity, giving people the opportunity to come aboard with us, to make money with us, either part-time, maybe a career change. Everybody's got different reasons for wanting to get involved. We're going to talk to you about that when we talk about the presentation. But for now, treating it like a business as you're a part-timer means you need to grow an organization. Your regional vice president will help you. Your previous trainer will probably help you. But whoever can help, Doug Hartman will help you. Everybody will help you. But you've got to treat it like a business, which means just like if you were a real estate broker. If you were a real estate broker, your job is not primarily to go out and sell a bunch of houses. As a real estate broker, your job is recruiting and training real estate agents. And then you live off that override. If they're on this contract and you're on that contract, you get the difference as an override when they sell a house. And if you have a whole slew of agents in your organization who are real estate licensed and you're broker licensed, and believe me, I know because I am real estate broker licensed. I don't use it, but I am licensed. So your job is to recruit and train new associates for your brokerage. They sell houses, you get the overrides, and everybody ends up happy. Well, that's how you build an organization. Primerica is very simply a brokerage. We are a brokerage. We've modified the idea of brokerage to the extent that we allow people to even start getting overrides before they go full-time as a broker. A broker in our business is called a regional vice president. But before you get to that full-time position, you can still override the people in your organization. You could be a regional manager, a regional leader, and you can override district leaders who are out there training all the time. You get that override. And that's how it works here too. Treat it like a business. Keep on building your organization. Use anyone and anything who is willing to help you. Don't ever use anybody that doesn't want to be used. Don't ever abuse anybody. Don't ever steal from anybody. Don't ever cut little corners and stuff like that. Do it right. Build it godly. Build it the way that you know the Lord would honor it, and He will honor it. But treat it like a business. Now, once you go full-time, you really need to do a bundle of appointments, because now you're building people. You are recruiting new associates for your people. That's your primary job as a broker with Primerica, a regional vice president. We call them an RVP. That's your primary job, is to recruit people for your people, to help them build an organization, and to help them do it right, to help them train. Doug Hartman always taught us that you need to continue to work with people until they are 4 deep. When they're 4 generations deep, then they're probably going to be able to take care of it themselves, go build another leg of people. But no matter what, the entire time that you're in business, make money. The reason that we call people district leader, division leader, regional leader is because leaders lead. They lead by example. If you want your people to be successful, go be successful. If you want people to make money, go make money. If you want people to train and do what's right, well, you train and do what's right. Lead from the front. Lead by example. And thank you for watching. Tune in next time, and we'll have more training for you. God bless you all.